Get Rich Education is brought to you by Ridge Lending Group, Apartment Investor Mastery, and Producers Wealth.
You're listening to the show that has created more passive income for people than nearly any show in the world. This is the powerful Get Rich Education.
Welcome to Get Rich Education, episode 187. I'm your host, Keith Weinhold, and today we're going to talk with one of the nation's more prominent loan originators of income property loans for investors just like you, who'll be joining us shortly, and you'll find out what the latest is on what your minimum down payment requirement needs to be and what your investor interest rates are going to look like today and more. But first, let's talk a bit about how a mortgage is used as a tool for you. Now, 10 or 20 or 30 years from now, do you think that real estate is going to be worth more or worth less than it is today? I think most anyone, if they had to make a guess, would say more. Now, if it's going to be more, well, then you want to own and control more, and you can own and control 5 times as many properties if you have 80% loans on all of them and 20% down, rather than having them in a paid off position. And yes, it's really all that financially free beats debt-free reasoning that we discuss here at GRE. I think that real estate investors, just in general, have a predilection toward being maverick. And then, even among real estate investors, I think that most of the strategic, better thought out investors, they want to prevent an accretion of equity from taking place in any one property. Home equity is unsafe, illiquid, and its rate of return is always zero. So I want to lever as much property as I possibly can with it. Well, now, what is the risk of doing that? Well, to be on the safe side, you want to be sure that the cash-on-cash return of your income property meets or exceeds the interest rate expense of borrowing. Well, knowing what we know about home equity, I then want to pay off a property as slowly as I possibly can. You see, you've got to realize that both tenants and inflation are already weathering. They're already eroding your equity down for you every single day. So therefore, I don't want to chime in and get involved with paying down extra principal myself, because for every $1 of principal pay down you make, that's exactly $1 less of cash flow in your pocket today. And you probably want to maximize your cash flow. Well, for this reason, my favorite loan is actually the interest-only loan, which is something that only sounds irresponsible if you don't follow what I just said. But interest-onlys are not so readily available, so I like the 30s. Now, even if you could get an interest-only, it has a balloon payment in 10 years or less. So do you know what my favorite amortizing loan type would be? It would be something else that's not even available in the United States, and that is a 100-year fixed rate mortgage. I would love it if I could convert all my 30-year mortgages into 100 years. And well, how would that look? Well, the most important positive consequence, if you could do that, is that your monthly cash flow would increase. You got an increase in passive income. You would not be accumulating equity so fast. You would be converting your equity into cash flow. And see, that's kind of what you want to do when financially free beats debt free. And what you would have done is given yourself flexibility by now only having to make that lower payment on the 100-year rather than the 30-year, and you could still make extra principal payments if you wanted to. So you've given yourself an option. Now, what if you had to go the opposite direction and your 30-year mortgages had to be converted to 15s? Well, in that case, it would have the opposite effect. You would have just lost a substantial amount of passive income, and you've gone from cash flowing properties to negatively geared properties in a lot of cases. And going from 30 to 15, it means you would accumulate equity faster, that zero return ingredient. You would be converting your cash flow into equity by going from a 30 to a 15. And that's probably the reverse of what you want. That means you would be putting debt free in front of financially free. And finally, by going from 30 to 15, you've lost flexibility. You must make the higher 15-year payment or else you'll default on the loan and wreck your credit. And there are so many more reasons that additional equity hurts you and often puts you at even more risk. And I'm not going to go over all those today. If you want to go back and listen to GRE episode 163 about this, that is paradigm shifting material for a lot of people. Now, if you think this 100-year mortgage concept is outlandish or unprecedented, well, it's not. It's not being used in the US, but 100-year mortgages have been used quite extensively in Japan. Now, over there, the Japanese real estate industry, they opened up 100-year loans a while ago, and they didn't really do it so much for income property reasons, but that was to promote home ownership with the creation of these 100-year terms. And then the home, just constantly encumbered by the mortgage, it becomes an ancestral property, and it's passed on from grandparent to grandchild in a multi-generational fashion. And we don't so much live that way in the US, where we're a more mobile society. Look at Sweden. A couple years ago, Sweden cut the maximum mortgage term down to 105 years because the average mortgage term there is 140 years. So I'm not discussing pie in the sky stuff here. The reason that I've floated the concept of the 100-year mortgage out here to you is that if you understand that that would assist you in converting your equity into cash flow, then you've got a good understanding of leverage, arbitrage, and debt and equity. And so much so in an era when interest rates are still low, paying extra principal just really defeats the purpose. Now, this whole thing, it is a paradigm that I would potentially revisit if, say, in a decade that mortgage interest rates were 5 times inflation and 2 times what you could get on cash and cash returns somehow. But oh, how I would love a 100-year fixed rate mortgage. Well, hey, I'm coming to you from Reading, Pennsylvania today. This city of 90,000 people, about an hour northwest of Philadelphia, lent its name to the Reading Railroad in the board game Monopoly. Reading, Pennsylvania also happens to be my birthplace, and I'll be heading to upstate Pennsylvania tomorrow to visit my parents because I want to spend Mother's Day with my mom. And hey, financial freedom can buy you the time to do what you want. Now, the mortgage landscape and qualifying terms change pretty frequently. Let's talk about what it takes for you to qualify for an income property today. In the latest year ended, today's guest ranked number 1 in units closed across all of Highlands Residential Mortgage. And then among all companies, he is ranked number 11 in the state of Texas. He's even ranked in the top 100 in the U.S. according to the Scotsman Guide. Mortgage Executive Magazine ranked him in the top 1% of mortgage originators in the U.S. He is also top ranked by Ask a Lender. Welcome back to Get Rich Education, Graham Parham.
Thank you, Keith. I appreciate all the comments, but that was very nice. But it's always good to come back, Keith. I enjoy being on your show.
Besides all those shiny awards, you know a distinction that Graham has that I really appreciate about a mortgage loan officer, but you won't see this hung on a wall or resting on a mantle. It's the fact that he actually owns income property himself. He gets it, and they don't issue engraved plaques for that right there.
Yeah, I do drink the Kool-Aid. There's no doubt about it. But, I mean, you and I both know I've been doing that at the same time you kind of got in the game, and it just makes sense. I mean, I like practicing what I preach. It just makes sense, makes my job easier. You know, dealing with clients, when I tell them that, it kind of puts them at ease, and I think that's a good thing. So, yeah, I'm still buying today. I bought 2 last month, and I'm looking to buy another one next month. So, yeah, I'm still on a roll.
And you buy a lot of single-family turnkeys.
That is correct.
Now, Graham, before I ask you about required percents down and credit scores and all that, I have 2 questions that I promised other listeners I would ask you about. Now, what if someone has 1099 income but not W-2 income? So that is like they have entrepreneurial or freelance non-employee compensation rather than a W-2 day job. What does their situation look like for lending?
We work a lot in this particular field with self-employed people. Sometimes they have just one company. Sometimes they have multiple companies. 1099 is a variable income, which means that from month to month, obviously, we don't know what the income is going to be from gross revenues or whatever they do as an occupation. But in the Fannie Mae world, they like to see consistency. And it kind of falls back on the rule from the Dodd-Frank Act saying the ability to repay. Does this individual have that ability to repay? And they want to show a history saying, yes, they do. So some lenders, and it really varies because what we do is we compile your information, we plug it into an underwriting engine from Fannie Mae or Freddie Mac, and then we upload it. And then it comes back and says, okay, we like the individual. We only need 1 year's of tax return. Okay, sometimes that's a good thing because let's say they started their business January of 2017, they got a full year, and we've got a tax return, we're ready to go. Sometimes that's all we need. A lot of times it says we want 2 years. So if that's the case, then a lot of times those 1099 individuals may not be eligible for a loan until they get a 2-year history on their bet. Now, of course, the W-2s are no brainer because they're doing a stable salaried income, which is relatively consistent from 1 year to the next. So those are a lot easier to deal with. But I guess what I'm trying to tell the listeners is don't discard your limited time on being self-employed. Let us make that determination, okay, because it is case by case.
Is there anything a 1099 person can do to strengthen themselves throughout the year?
You know, it's all numbers. People that get in the business, they want to take advantage of the tax rulings and, write off as much as they can for the business. So keep in mind, when you're writing off all these deductions, we do take that into account. So we do look at a net income. So a lot of people that have multiple business, they like to write off everything, where sometimes they come up with a negative number. Self-employed individuals like that own a company, and let's say it's in an LLC or an S corp. Okay, well, they pay them a salary from that company to the individual. But when we go back and look at the company's writing off all the expenditures where they're actually in the red as well. Well, that comes back to haunt the individual income. So keep that in mind as well.
Now, we have listeners in 188 world nations, but most of those are in the United States. As far as those foreign nationals, though, what loan programs are available for them that want to invest in U.S. income property? What does that look like for those borrowers?
There are foreign national programs out there. Several firms offer that. The terms are nowhere near like it would be with Fannie Mae and Freddie Mac. They're very difficult to accomplish, so you want to make sure that you get with that particular lender that understands foreign national, because you never know what country they're going to be in. But if there's an individual that's from another country and they live in the U.S. on a visa, we'll do that all day long on a Fannie Mae. U.S. citizens that live abroad, and I'm doing one now with a guy who lived in Tokyo for last 10 years, no problem there because they're still generating U.S. income and U.S. tax returns. So the foreign national, pure foreign national, yeah, they do have them. I think the loan to values are down like 50%. The rates are much higher, but they are out there. So don't be discouraged if you are a foreign national.
Okay, so it is happening, but 2-to-1 leverage and higher rates. Now, going ahead, I just want to clarify, we're talking today about conventional loans on 1 to 4 unit rental property. So we're not talking about primary residences. We're talking about rental single-family homes up to fourplexes. What do the percent down requirements look like today, Graham?
Well, the good news is that we can go all the way up to 10 loans these days with 20% down. It kind of struggled over the last 3 or 4 or 5 years. It went from 4 and now it went to 6 and now we're all the way up to 10. The only stipulation is the properties 7, 8, 9, and 10 that they do require that you have a 720 credit score or higher. That is a hard stop. But as far as putting 20% down across the board, it is available for all properties for single family only. 2 to 4 units is always 25%.
Okay. And now we have a requirement called the ATR rule. ATR is ability to repay, not for flippers to confuse that with ARV, after repair value, but we're talking about the ATR, the ability to repay. There are all these acronyms in real estate investing, and there are really 8 different factors that underwriting considers there with your ability to repay as a borrower. Tell us about those.
It's just broken out a little bit more than it has been in the past. The way conventional lending works is there's 3 categories. We take a look at your credit, take a look at your earnings, and then, of course, your assets, enough funds to close. So, and if you want to categorize these into like 8, so to speak, we're going to take a look at your current income or assets. We're going to take a look at your employment status, credit history, of course, the monthly payment on the mortgage, monthly payment on any other mortgages that the borrower has at the same time, and then monthly payments on other mortgage related with expenses like property, taxes, insurance. It really kind of comes out to a net. And then any other debt, credit card debt, car payments, everything. And to be simplistic is we take a gross monthly income. Then we take whatever the required minimum monthly debt is on all the things I just mentioned, and it's simple division. And if the division comes out with a number, which we refer to as a ratio, the ratio, and most lenders stop at 43, 45, but we can take it all the way up to a 50% debt to income ratio, and that's the total debt. Now, the good thing is on an income properties, when you're buying a property, that the income from that property, we're going to give the borrower that income. So whatever the liability associated to that property will be offset by the income. So a lot of times people say, well, how many can I buy? Well, if you can approve for one, you can approve for five because they're all talk to each other and they're all income properties. So nothing to be stressed out about. It's just the ATR rules, a part of the Dodd-Frank Act that's been around since 2010. And they're just a little more critical. We've been living with it for years. In my opinion, it's just business as usual.
So just to review, we're talking about the ability to repay factors considered by underwriting. There are 8 of those, and one of those 8 that you mentioned is the DTI, the debt-to-income ratio. And just to give a simple example, if all your monthly debt payments are $2,000 and your gross monthly income is $5,000, that number, $2,000 divided by $5,000, is a 40% DTI, or debt-to-income ratio, and Graham just let us know you can go up to 50% on that and still potentially qualify.
Correct.
Now, what about reserve requirements? I know reserve requirements have changed pretty substantially in the past few years. I think they've gotten more lenient, and it comes down to something called the UPB, another acronym.
Unpaid principal balance.
Thank you. Tell us about that.
The old rule was, okay, for the first 4 properties, you had to have principal, interest, tax, and insurance in any HOA, times 6 on the subject property, and times 2 on any other properties that you owned. And then when you got to 6 or better, then it was 6 months across the board.
Okay, so that's old news. So we have new requirements.
Yeah, the new ones is they take a look at your aggregate balance on any mortgages outstanding. And it is categorized by the number of mortgages. As an example, from 2 to 4 mortgages, if you have 4 mortgages, and let's say all 4 mortgages added up to $100,000, then we have a multiplier of 2% against that $100,000. Consequently, there's a $2,000 cash reserve. Then we stair step from 4, we go from 5 to 6. The multiplier now becomes 4%. So 4% against 100,000, now you're at 4,000. And then, of course, from 7 to 10, it bumps up to 6%. So 6% against 100. So what we do is we take a look at your credit report. We take a look at the balances on those mortgages. We add them up. We make that multiplier, and that's where your reserves comes into play. Now, the good thing about it is a lot of people think they have to have those in liquidity, and they actually do not. We can use non-liquid funds. And the old rule used to say, okay, if it's an IRA, it's $100,000, we'll give you a credit for 60% of that. Now we give you up to 100%. So that's a good thing. So the only thing we cannot honor for reserves is any funds coming in on a HELOC. But other than that, we can use liquidity in your bank, non-liquid funds for reserves. So a lot of times people kind of get nervous about the reserve requirement, even though they already had it.
Okay, so just to review, since we had a number of numbers flying around there, so let's say we have a borrower out there that currently has 3 financed income properties, and we do want to separate those out because these requirements exclude the primary residence and they also exclude the subject property meaning the one that you're trying to qualify for now. And let's say that borrower's 3 finance properties, say they each have a $100,000 principal balance. That's a $300,000 total principal balance times 2%, since that's the unpaid balance requirement. That means that borrower needs a minimum of a $6,000 reserve requirement.
Correct.
So things have gotten considerably more loose. These UPB, unpaid balance requirements, I think they're easier to meet than what the old PITI requirements were.
I think so. Yeah, I think it's to our benefit. So that's all good.
Why don't we talk about rates and just where are interest rates right now? And of course, these things are always changing and there are an awful lot of adjustment factors. Tell us about conventional rates.
Well, Keith, since you asked and you told people that I was already an investor, and I've been working with investors for close to 20 years. And you talk to any of the veterans that have been, investing since the 80s, they'll all say that, anything below 7% on an interest rate for an investment property is still a good rate. In my opinion, that's still true today.
Yeah.
Now, the thing that it is, we've all been spoiled over the last 8 years with the last administration and the rates came down to the very, very lowest that ever been. And so, consequently, it makes the numbers look a lot better, especially on cash flow. Now, they have come up. So they started coming up pretty aggressively around the holidays, and they took another spike in January. So from, say, this time last year to where we are today, well, we're about 7/8 to almost a full point higher than where we were. Now, is that going to kill the deal? In my opinion, no. Does it make it a little harder for people to sell, healthy cash flows? A little bit, but not much. I mean, if you talk to any of the providers out there, they're all trying to hit the 1% rule. And then, sometimes that may vary depending on their percentage of down payment and so forth. But yeah, it has come up a little bit. And there's several things that a lot of people don't understand about rates, especially the new guys, is that from an owner-occupied perspective to an investment rate, it can vary anywhere from a half a point, sometimes up to 3/4 of a point higher. And they just kind of go, well, that's not what I'm seeing on the internet. Well, what you're seeing on the internet are, owner-occupied rates. So yeah, I have to go through a retrain process with them. But there are several things that go into the rate. A loan amount. It starts at like 150, 125, 100, so forth. And every time that the bracket goes down a little bit further, then there's adjustments to make the rate go up a little bit. And then, of course, credit scores. As an example, I can just provide you with an example here. And I'm taking rates from 3 days ago because I didn't want to take them today because I didn't want my phone to blow up. But let's just take a 740 credit score, which is your highest threshold for Fannie Mae. And you're doing a 25% down on a property, say $150,000.
740 is the highest credit score in which you get additional help with rates and terms. So whether you have a 760 or a 799 or an 810, it's not helping you out anymore here. And if you have a credit score that's really high, it might just exhibit that you're not using enough of your credit.
That's true. We always like to pride ourselves on the highest credit score we can, but you're right. The 740, and people say, well, am I going to get a great rate with 760? Absolutely. Can I do any better? No, 740 is it, okay? And that's pretty much all lenders across the board. And what they do is they break it down into 20-point increments is where they start seeing the adjustments, 740, 720, 720, 710, and so forth. And where they really start to nick you up pretty good when you start falling below the 700 mark, then your adjustments start to get a little more aggressive. So I can give you just a brief example if you like, Keith.
Yeah.
If you take like a $150,000 property and you're putting 25% down and you got a 740 credit score, today you're probably going to be with 0-point pricing. And a lot of people don't understand that means there's no points being charged. You're probably going to end up around a 5.25 rate on a 30-year fixed rate with no prepayment penalty. Now, if you drop down to, say, between 620 and 640, which is your lowest bracket, now all of a sudden, because of all the adjustments, you went from a 5.25 to 5 7/8, and now you're having to pay a point or 1.25 to get there. So you can see they start to tear you up when you get below the 700 range. But let's stop and think. 5 7/8, anything below 7%, in my opinion, is still a win-win.
Most people predict that interest rates are going to go up rather than down, and they've really been forecasting that for quite a while. But yeah, as Graham's just told us, we've seen an increase of about 7/8% or so. Is that off the bottom or just in the last year?
I would say within the last year,
okay.
And I'm referring back to when I was closing some of my properties last year, and I was ranging around the 5 7/8 range. If you do a 20% down, then you're probably going to be in that particular range. If you're 25% down, as I alluded to, you're going to have a much better rate. But just keep that in mind. There is a price break between 20 and 25%. So, yeah, we're up about 7/8, almost a full point.
So we're just talking within the last year. And 4 years from now, if you think interest rates are going to be, just say, 7%, you really are going to deem this year as a year where you still could have gotten in at a very low rate, and then you've got it locked in. And if interest rates go back down, then you have the option of refinancing it. So, really locking it in, it's still a relatively low rate, gives you an option. And I mean, I'm too young to have experienced this, but I know in the early 80s when mortgage interest rates were 16 or 18%, that people consider these to be a phenomenal rate, and you're locking it in for 30 years.
Absolutely.
Are there any more critical adjustment factors when it comes to interest rate?
Well, when I talk interest rates to people, I try to put two hats on. Of course, the loan officer hat, then I try to put my investor hat on, saying, what would I do in this situation on this particular loan? And when it comes really down to points, people say, well, I really want a better rate. Can I buy it down? Well, sure you can. But let me just kind of I run these numbers backwards and forwards all the time, and keep in mind the sweet spot could be anywhere from say $80,000 to $150,000. Okay. And when running these numbers, buying a point for every eighth increment of rate, it costs a half a point. From 5% to 4.875, it costs you half a point to get there. And once again, if you do a 0.25%, it costs you a full point. Now, when you run the principal and interest payment and take the difference of the 4.75 to the 5%, you could only be talking, $6, $7, $8, $10. But you divide that into what that point cost you, and 9 times out of 10, it's going to put you about 57, 58, 59 months, which is a little out of the 3 to 5 scenario that I like to keep. Because if you're going to pay a point, you're going to make sure you get a return on that point within the 3 to 5 years. So reducing your interest rate to tell your friends and family, hey, I got a 4.75% rate. Well, that's good, but it's going to take you 57 months to recoup it.
Right. Your break-even point has such a long duration that it's often not worth paying for a discount point at the closing table, which is money out of your pocket right now. So in most cases, you want to go ahead and retain cash in your pocket right now. You're listening to Get Rich Education. We're talking with Highlands Residential Mortgage Senior Loan Officer Graham Parham. More when we come back. I'm your host, Keith Weinhold. MC Laubscher is the host of the top-rated business and investing podcast, Cash Flow Ninja, and also the president of Producers Wealth. Producers Wealth assists people in creating, protecting, and perpetually multiplying wealth in any economy through creating processes that help them increase their production, provide them with liquidity, passive income generators, and opportunities for enormous growth. Learn more about their time-tested and proven systems at yourownbankingsystem.com. For an income property investor like you that needs an income property loan, go to Ridge Lending Group. And over the years, you've heard owner Chaley Ridge generously give her time to you right here on the show as a guest. Ridge provides investment property loans in almost every U.S. state, and you're going to find out how they've helped more Americans realize their dreams of financial freedom through real estate than any other mortgage lender in the entire nation when you get started at ridgelendinggroup.com.
This is our Rich Dad, Poor Dad author, Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. And the reason I respect Keith, he's a very strong, smart, bright young man.
Welcome back to Get Rich Education. Our guest is Highlands Residential Mortgage Loan Officer Graham Parham. His website is texasinvestorloans.com, even though he originates loans in 15 states and a lot of the best cash flowing markets. Graham, talk to us a bit about some other things that sort of borrowers commonly ask about, whether that's comparing 30-year fixed rate mortgages with 15s or ARMs, or, what kind of things do you tell a prospective borrower?
Well, first of all, I haven't sold an ARM product in probably the last 5 years. And I think, Keith, you probably shared that on one of your last shows, better minds than mine, that, we're kind of in an inverted market where the ARMs, they don't shine as bright as they used to. And as an example, if you want to do that same equation that we talked about, you could probably get your rate down, but you're having to pay like 2 and 3 and 4, 5 points to get there. It just doesn't make sense because the ARM products just don't have the margins in them that a 30-year fixed rate. And you might as well just stay with the 30-year fixed rate because it's down, like we talked about. Just it just makes sense. But now on the 15-year, a lot of people come into this cash flow strategy with just the opposite strategy, and they want to say, well, I want to pay it off quickly. Well, you're limiting your cash flow, one, and then if that's your objective to have all your properties free and clear, that's fine. But in my opinion, that's not the best strategy. I just got through doing an exchange last year and sold 8, bought 9, and then I bought 6 this year. And I'm in my 50s, and people say, well, did you put 30 years fixed rate on all of them? I said, absolutely. And they said, well, don't you want to pay them off? No, I want to keep them until I die. I'll let my heirs worry about that because I know what the kind of cash flow I'm getting today is. I'll know what the kind of cash flow I'm getting tomorrow. So that's the main reason why I do 30-year fixed rates. Leverage is your friend. Use it.
Exactly. I am such a proponent of the 30-year fixed over the 15-year. With the 15-year, the borrower has less flexibility. They must make that higher payment. You're also losing leverage when you pay down your principal faster. You're investing more in a zero return component, which is what equity is. And we're income property cash flow centric investors here, well, you're just losing cash flow with that higher 15-year rate. And, what are you trying to chase down or pay down anyway? So, yeah, I really don't understand those that want to go with the 15-year. I think those 15-year proponents, Graham, what they do is they compare two amortization schedules, a 30 and a 15, and they can very easily point to the amount of interest that they're saving with the 15 rather than the 30. But the thing that they fail to consider is the opportunity cost. And rather than having that interest savings be that number, which is often in the hundreds of thousands of dollars over 15 to 30 years, well, instead, they don't look at what they would do if they invested that money instead, especially invested it in more income property.
Exactly. In my opinion, I set up a different checking account because I know all the income comes in. I want to separate it from my personal income, and I want to compile that. When I'm ready to go for another property, I reach into that account and go buy another one. So I'm not taking those dividends away because my strategy is to build up as many single-family dwellings as possible. So when I am ready to retire, then I can start taking that money.
Now, you've run a good example showing the benefits of using 20% down leveraging for properties versus buying one property and paying all cash for it. So tell us about the comparison.
A lot of people come to me and say, well, maybe I should just pay cash for a property. Okay, that's fine. That's your prerogative. But let's take a look to see how that's going to work in dollars and cents and where you would be if you did leverage. Let's just take $150,000. All right, I've got $150,000. I'm going to pay cash for a property for $150,000.
Okay.
Now, the numbers I'm going to rattle off does not take into account taxes and insurance. It only takes into account the principal and interest for comparable sake. So, as an example, you put $150,000 cash. You have no debt. You have a monthly income. Once again, if you get a 1% cash flow market of $1,500. I even plowed in an additional 8% for vacancy and another 10% on management, which is higher than most people that you're dealing with. So you're now down to $1,245 a month from that $1,500 a month of rent. Okay, fine. If you took that $150,000 and bought 5 properties with 20% down, then you put $30,000 down on each property. Your loan amount's $120,000. Your principal and interest payment is $644. And then here comes the rent. So we're going to add the rent back in for the $1,500. We're going to take out the vacancy and the management again. Now we're down to $600 a month of net income compared to $1,200. What is that, about half?
Yeah.
We'll take the 600 times 5. The numbers speak for itself. Use leverage. It is your friend.
Right. So versus paying all cash, if you just make a 20% down payment on a property, you've only put out 20% as much skin in the game. So you really want that multiplier effect of having those 5 properties leveraged. And then additionally, you have the opportunity to be diversified across different markets when you own 5 properties rather than one. And of course, if you have one vacancy and just one property that you paid all cash for, well, you have 100% vacancy. But if you have one vacancy where you own 5 units, you just have a 20% vacancy.
I'm so glad you said that. It took me a while as an investor to understand that. Once I got multiple properties, having one vacancy didn't sting at all, because it's being taken care of by the other ones.
It really is counterintuitive. The road to wealth creation, that road has many intersections with debt, and that debt is smart when it's outsourced to your tenant because you can control more, 5 properties rather than one in this case. Well, Graham, are there any other things that you see that are some snags that a borrower runs into that they might be able to head off or that they might not be able to do anything about, whether that's low appraisals or rising interest rate or any closing cost factors?
I guess the only thing that we're probably experiencing right now is some differentials in appraisals because a lot of markets, let's take Dallas as an example. I mean, we're experiencing probably some of the best appreciation we've had in a very long time since I've been here.
Yeah.
And other markets are experiencing that as well. Most of the markets, Keith, that you work in, they're not really high appreciation markets where some are a little bit better than others. But the fact of the matter is that, in like the state Dallas as an example, I mean, we're trying to catch up on paper to try to catch some of those new values. Well, appraisers are only human. Their job is to give their best foot forward in the way they determine where the market is and what this particular property is worth, predicated on the market comprehensive data. Some appraisers don't understand the turnkey concept better than others. And so sometimes they may not take in all the considerations, the upgrades, the whole 9 yards, and they may miss the mark. Well, that does cause a problem. And that causes a problem back, into these buyers and sellers arena where they'll have to work it out, because we as a lender can only loan against the appraised value or contract value, whichever is lower. So we are from time to time seeing a miss or two, and depending on the markets where we're missing. But I think for the most part, I was talking to an individual last night out of Memphis, Tennessee. They're still hitting 90% of their appraisals. That's a good thing. That's a very good thing.
So what do you see happen very often in a case where, say there's a contract sale price for $180,000 and the appraisal only comes in at $175,000? How's that $5K being made up? Is the borrower very often showing a willingness to go ahead and pay that extra $5K and lose some leverage to get the property?
They are. It depends on the provider and the seller, but yes, they are, because they're buying an asset that's still going to generate the same income. If the value itself, as far as the appraiser is concerned, is not, we're off $5,000, well, they know for a fact that's straight equity. Do some of the sellers kind of work with the buyers? Yes. Some do, some don't. But as an investor, you have to make that determination. Is that $5,000 still worth it to throw at the property as straight equity? It's not a cost, it's just straight equity, and you still get the same cash flow. So it's really a case-by-case scenario.
That's true. In a case, it's not a cost, but you have just converted your cash into what I would call a lower use dollar, an equity dollar. And, okay, so sometimes you might see a seller meet that borrower in the middle, and they'd each go ahead and make up $2,500 in that case.
Correct.
Graham, the lending environment is such a fast-changing environment, so is there really any last thing that a prospective borrower ought to know for qualifying for an income property today?
No, I mean, if you're sitting on the sidelines thinking that you can't get a loan, well, then rethink it. Come to me. Let me give you a simple yes or no. It's a very simple process. We get you a 15-minute online application. You supply me with some income and asset docs. We'll run it through and get you an answer in a day and a half. And there's no gray area. You either can or you can't. But don't discard the fact that you think you can't. Let me give you that answer.
I like that attitude. What's the best way for someone to get a hold of you?
I have a direct toll-free dial, which you can reach me anytime, day or night, which is at 855-326-6802.
I really suggest reaching out to Graham and seeing what you can do. And thanks so much for coming back out of the show.
Oh, my pleasure, Keith.
Well, it's great to get the latest from Graham. Now, 3 weeks ago, macroeconomist Richard Duncan was here on the show, and we dug deep into just what changes interest rates, and he concluded that the probability is that they're going to continue to go high, and that probability is quite strong. You know something? When mortgage interest rates are in a decline, people become pretty complacent, and they might even postpone a purchase because they expect rates to improve. But when rates rise like they have been, people really have a sense of urgency to get in. I do as well for my own purchases this year. So for single families, you're looking at 20% down plus, it depends on the state, but usually about 4% for your closing costs and prepaid. So you're coming in at about $24K on a $100K property. And I've talked before about how you can increase your cash-on-cash return, remember, by getting the seller to pay maybe $2K of your closing costs, and in exchange, you pay a purchase price of $2K more. That way, you would only have to bring $22,000 to the closing table, but you are going to risk that fact that now your property must appraise for $2,000 more. That's the trade-off there. Yes, mortgage loan officers still ask you for a bunch of documentation, so be prepared for that. You are a pretty savvy listener. I'm always impressed when I meet you in person and get to talk to you. And it really only seems like it's novices that seem to fall for some of these national mortgage lenders that tease you with things like, hey, look at us over here. Rates are as low as 2.99%. And then you know what? Once you've sunk your 15 minutes of time into their online application, you find out that you've been sucked into quasi-deception, because to get to that teaser rate, you'll find out that it's a 15-year loan and you've got to pay 5 discount points at the closing table. So Graham is a great lender for turnkeys because he works with a lot of the same providers there at greturnkey.com. And Graham even owns property himself with those same providers, just like I do. Another advantage of working with someone like Graham that operates in many different cash flow states is that you're going to be more likely to have fewer problems with multiple credit inquiries, and you're just going to have one pre-qualification rather than many of them. And Graham is great with 1031 exchanges too. So his phone number and free investor loan guide are both in the show notes. And although he's in multiple states, again, get started at TexasInvestorLoans.com. Next week, I'm coming back to help you build your wealth as I'm going to talk more one-on-one, just you and I then. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
If you want to retire in 5 years or less through real estate investing, then pay close attention as I'm about to share my proven recipe with you. This is Brad Sumrock, and I've taught thousands of people just like you how to replace their incomes, quit their jobs, or simply have more income and freedom than they ever thought possible. And we do this by investing in apartment buildings. After starting with no experience, I managed to pocket over $1 million in cash and retire from my 17-year corporate job after only 3 years of apartment investing. And I have hundreds of successful students that have had similar results. If you want to get out of the rat race or simply have more income and freedom in your life, then investing in apartment buildings might be the answer for you. Visit our website at bradsumrock.com to get more information about our upcoming training events. That's bradsumrock.com.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.